So this is the next installment of the How I Trade series, and today we're going to go over entries, chart patterns, and whatever else surrounding that. Um, so I use a few different entries. So the first one we'll go over is the engulfing candle. Now, whenever you enter your zone, or whenever you have a zone of supply, basically when price comes back into it, you're really just looking for a reason to enter. So the first way that I enter is an engulfing candle. And you can see here I've marked out this zone of supply. And then if you look over here, we have an engulfing candle. Now, whenever this happens, like say price was here, basically I'm just waiting for the next candle to engulf. Now, one thing I want to note is that you can drop down to your micro time frames or your whatever time frames you use to then find engulfing candles there. Like I just dropped down to 15 second. Let's see if we see one. We might not. Okay, that looks like an engulfing candle to me. So I would enter here, and then my stop loss would be here. Now, if you're risky, you put your stop loss above the candle. But if you want to be safe, you would always want to put it above the zone. So in this case, it'd be risky because I want to put it above the candle, and then we just target 1 to 3 here. Let's see if we hit it. If we don't, that's fine. I think we do, but let's see what happens. Just gonna hit play. 15 seconds taking a sweet time. There you go. So we hit it, right? And then basically, now if we go back to the 1 minute here, you know, our entry would have cut that candle in half. But that's beside the case. We enter on engulfing candles if price comes back into the zone. Now that's an example of a bearish engulfing entry. Let me go back here for a bullish. So I've marked out a few on the charts here. So you can see we have our zone of demand. It led to a break of structure for number 2. And then back over here, this is number 3. We get our engulfing and we just enter. Now, in this case, I put my stop loss outside of the zone. But if you wanted to put it under the candle, you could. You get a better risk to reward, but your risk is higher for, let's say this wick here happened and wicked you out of the trade and then made a giant candle, right? You just get a higher chance of being stopped out by spread or liquidity grabs or whatever that happens here. So usually I'll put it under like a swing low or put it under the zone, right? So we have the zone of demand. There was our engulfing 1 to 3, easily hit. And then we have this other one where we can move our zone of demand here, right? And we don't get an engulfing. So price comes back, or we don't get engulfing until a little bit later. Price comes back down into here. We break some structure in here, a little short-term structure here. And then we don't get engulfing for 1, 2, 3, 4 candles. And now we get this engulfing and we can enter. Now in this case, I didn't put it under the zone. I put it under the swing point. And that's still pretty safe, I think. It's a little bit wider of a stop loss than putting it under the candle. But you're kind of out of the way, because what you're saying is that if price comes back down here, you don't really want to be in, like the trade idea is incorrect at that point, right? Okay, so that's an example of bullish engulfing and bearish engulfing. Let me go back to the zone we were at for the bearish engulfing, and I'll show you another way that I enter, and that is called the quasi. So quasi is basically a head and shoulders on a in candlesticks. So in this case, this would form our left shoulder. We have this bullish, bearish, bullish. This would form our head. We have this bullish with a bearish candle next to it, right? And then we have a right shoulder, which trades, you know, up below the head, right? So that would be this bearish, bullish, bearish. And you can either enter on these right shoulders immediately. So you'd enter here on this engulfing on the right shoulder. And your 1 to 3 would be hit here. Or what you can do is you can draw a zone on these right shoulders, so a zone of supply. And you could take the missing price if you wanted, or you could just draw it on here. But regardless, it doesn't get hit until over here. And of course, you already know you get faked out in here with this engulfing if you entered on engulfings. Okay, so that's a quasi entry with the right shoulder for a bearish. And we can say this would be a bullish one. I would say that probably after this here, this would be my right shoulder entry. Reason being is because you usually want the right shoulder to, like, how do I explain this here? So you can enter this as your right shoulder if you want, but usually what'll happen is it'll do a little bounce back into the head area, like here, where we did this bullish candle back into the head area and then dropped out. So I'm not good at explaining this. I wish I was to illustrate my point better. But basically you just need it to pull back. You need the right side to pull back. So like if you look at this as a quasi, this would be our left shoulder, this would be our head area, and then this pull back and then down right here, this would make our right shoulder, right? So basically on this one, you would just enter on the right shoulder here, stop loss here, and then you would go down. And one thing to note is that I didn't learn this till later, but these quasis are actually like engulfing candles on higher time frames. So if I did this here, I bet we would see an engulfing candle on like a 5 minute or something. Yeah, so there you go. So basically what the quasi is it's forming a turning point in the market. And when you see that, you can now know that, hey, it's possible we're actually forming like an engulfing candle in my direction, depending on what type of quasi it is. So if we go back to the 1 minute, we break it apart, and that's our quasi, which would be forming our base. But when the right shoulder forms and breaks out, then we're starting to form our bearish engulfing. Isn't that cool? I like it. So those are quasis. Let's go back over here. Now, between engulfing candles and quasis, you have some really good entries here. But then you have another concept called the return to impulse. And that would be when you make a quasi, but then return to that right shoulder or head area. I don't have an example of one that I marked out already, but let's see if we can find one, because they are at pretty much most turning points. Okay, so here we go. We found one. Now, I don't know if this one works out because we're in an uptrend, right? But we have two here. So depending on how you would mark this quasi out, you could say this is a right shoulder or this is a right shoulder. But when there's like two things, like the two areas of supply, I'll usually just take the whole area. So I'll do it like this. And obviously we have the benefit of hindsight, but you have your right shoulder area here, or your zone of supply right now, and price goes away. But when price goes away, it usually returns to the impulse that created the that led to the break of structure, right? So you would enter when we returned. This one's a little bit more cut and dry next to here. So you have your left shoulder here. Let's do left shoulder, head, right shoulder. You got your zone around the head, right? And right here we stab right into the head, and that's the return to impulse. It's the return to the impulse that created this break of structure. All these breaks of structure in here, right? And so once you get there, I mean, you could enter on, your engulfing candle, or with this candle, it's just basically a tap. You can enter on the tap with the return to impulse, and that'll usually give you some good stuff. But in this case, let's see if we can find an engulfing, because I usually don't enter on taps. I usually do engulfings. Okay, so here we go. We got our engulfing candle, easy. Also a quasi. Look, left. Wow, it's kind of drawn weird. Left shoulder, head, and then right shoulder right here, right? These 15-second candles are kind of weak. I mean, they're kind of weird looking. So then, you could put your stop loss up here, stop loss up here. I would probably do at least 1 pip for spread and stuff, but your 1 through 3 is down here based on that return to impulse, and let's see what happens. Okay, we'd struggle for a bit. I don't know if we get it now because I'm crying. Everything's okay. This is taking too long. So we get it comes back up and does a lot of stuff. Let's see if we actually get it. I don't think we do. Okay, we got spiked out. Look at that. And if it actually, so we got caught in some consolidation there. But anyways, that would be your return to impulse entry, depending on how you enter. If you did enter on tap on that, then it would have easily been a 1 to 3. But since it was kind of like we're counter trend trading, you know, we got close. We would have got taken out of break even here because we break even at 1 to 1. But you know what I'm saying? Like, that's how a return to impulse entry looks. Let's find a bullish one. That's kind of funny, wasn't it? I was like, okay, this is that day. I want to see if we can find a bullet. We've been trending downward for a while, so I have to go over here into the sticks. This is actually a good example. What we used for our previous zone of demand here. So if we didn't want to use this bullish engulfing here, we can recognize that we have a left shoulder, a head, and a right shoulder as our quasi here, right? And so when we return, that is a return to the impulse that broke all of these different levels of structure, right? And so now, if we drop down to that 15-second time frame again, well, it's not as cut and dry, but we do have an engulfing here, right? And so we could enter. If we entered under here, we'd get taken out. If we entered under the swing point, like I've been saying, then we don't get taken out here, right? And then we take off. The other way you can read this is that if you took, and this is going to be silly, but if you took this area as a quasi, oops, this is the head, this is the right shoulder, and this is the left shoulder way out in the sticks, then if you took this here as the return to impulse, because we broke out of these levels of structure, then you could also enter here. Now see, this is where these entries get kind of silly, because I don't really like them that much. Like, I don't like seeing the market that much this way. I usually just like to look for the quasis and engulfings, but in a roundabout way, you kind of just get back to the return to impulse by doing quasis and engulfings anyways. Like, you just mess around and stumble upon the same type of entry. So it's not terrible. I just wanted to point it out. But yeah, my stops are usually under a swing point or under the candle, depending on how risky I'm feeling that day. And then, you know, take profit will be 1 to 3. Now, the other part of this is that if you're really feeling fresh, you can target like higher time frame areas of liquidity or missing price, like we were talking about. So like with this, you know, you'd assume that price was coming here. So like if we had just bounced off of this and we didn't know it was going to happen, we could assume that because we're in an uptrend, you know, that price would at least clear the liquidity since there's a bunch of wicks up here. So you just target that, let's see what happens, and we do clear it and we start to get a reaction, right? So that's one thing I like to do. On the way down, I would target areas of missing price. So I would target, like if I would set my stop loss at the same point, obviously. But if I was selling here, then I would target this area as a zone of missing price. And this is what I do when I do my long-term bias. I just look for missing price and then areas with a cluster of wicks for targets. And let's see what happens. Does it come back down? It does. And then you would just target this area of missing price next, right? Let's see what happens. I think that is the end of the data, actually. So you would get those same entries with the quasis and stuff. In fact, we could probably find one. You know, if you were doing like a quasi right shoulder entry, you could probably do something in here. This would be really ambitious though. You'd have to be like, oh, we just cleared the liquidity, so that was liquidity grab, and then you just be like, let's go down in here and see what happens. So you get your engulfing here. If you want to really take a risky entry, like you're like, yeah, we got our liquidity grab, man. All right, I'm cool. I'm gonna take it 1.5 pips stop loss, yeah. And then you're like, oh, my target's gonna be freaking smart money, like Superman over here, 1 to 20, right? And then you could take that. You could do that. That could be in your repertoire. But I'm only that brave sometimes. Right, so then you'd get that, and then, you know, you go back to the 15-second and look, you're like a genius, right? Because right now you have the power of hindsight too. So, but basically that could be like, you know, you can enter on that engulfing at the top there, or here's your right shoulder quasi entry right here on the 15-second, right? Either way, you're still going to be able to get, you know, that entry. And for this, you can actually, this is like a real head and shoulders too, right? Because you have your left shoulder, your head, and then this thing is like your right shoulder if you wanted to. But since I do quasis, I take the little like engulfers in there. So engulfing 1, engulfing 2, and then like I guess this would be engulfing 3 for the left shoulder. So I've recorded that entire video and I forgot about talking about my favorite entries, some of my favorite entries, and that's the double top and the double bottom. And I might trade them a little bit differently than other people, but before I get started, one thing I want to say is that basically you want to trade double tops in a downtrend and you want to trade double bottoms in an uptrend. Not to say that you can't trade them, you know, in the direct opposite direction, but what I will say is that your factor of success increases by a bajillion. I don't know how to quantify that, so I just said bajillion. I don't even know if that's a real word. But anyways, let's talk about double tops here. So the way that I trade double tops is that you have your zone of supply. You know, the lower the candles, the higher the area, whatever, right? That's, I mean, I had this other video about this. But if price comes back into that zone of supply and doesn't close above it with a body, and instead just closes above it with a wick, and then makes an engulfing candle, so we have our high here for our zone of supply, we broke above it with a wick, but then we made this engulfing candle. Well, that is a validated double top. Now to me, that's an entry, and I could put my stop loss above the candle, I could put it above the zone or the high, but either way, you know, you get your 1 to 3 eventually, I'm sure, right? It's not immediate, and this one you'd be kind of sad, but I think you do hit it eventually over here, right? So that's how I would validate a double top there. Now let me go over here. Once again, we have this area of demand for this is for a double bottom. In this area of demand, we are in a current short-term uptrend, yeah, which we're kind of consolidating here. And you know, we go up, we come back down, and the wicks don't break below it, and we just kind of hold here, and then we make this engulfing, and then we could enter right here for a buy. And of course, this one's an easy stop loss because all the you know, the liquidity and stuff is in the same area, so you can just go 1 to 3, and of course you get that pretty quickly. On the flip side, we have this double top here. Now look, let me just move this over. This one would be kind of a difficult one to trade, but you could still trade it. We have the high here, and this our supply zone here, and then we came up and then we wicked out of the top, but it's still valid because we then made an engulfing that pops out. Now if the body closed above here, like if this was a big bullish candle body that closed above here, we wouldn't want to trade this double top, but instead we could trade this double top. Now of course, to get a good entry, as we know from hindsight here, we'd have to then actually drop down to the lower time frames. In this case, it'd be the 15-second, but remember, this works on any time frame, not just for scalping. So you can use this for 1 hour, 15-minute, 4 hour, whatever kind of trader you are. You can definitely use this. Let's see, did I mark out any other examples? Yes. Okay, here's another good example. We have this supply zone here. We clearly wick out of the bottom, but then we make an engulfing, right? And this one you might get, so only if you put the stop loss under the enter candle. I would put it under here, and then we would try to take it. We'd get taken out at break even because I think you only get a 1 to 2 before it comes back, but that's okay. This still follows the rules. It's still my double bottom, right? And then as you keep going, I mean, you just kind of see these variations of this. So like you have double bottom here, but this one is an inside bar, so you'd probably have to drop down to a lower time frame to then get your entry. So let's see what that looks like. If I go down here, right, and go the 15-second. All right, well, we have our engulfing right here. Hooray, right? And then, you know, you put stop loss here, put your stop loss here. Obviously, if I was doing the 15-second, I mean, I don't know if it's obvious, but I'd be entering my stop loss below the zone because this is risky now, right? Yeah, 1 to 3 as usual. I think we get it pretty easily. Not much fuss, possibly. There you go. Right. So that's how you trade that double bottom there, and that would be like a reversal, I believe. So it'd be an interesting catch, right? And of course you have this big old double top right here. You got your supply zone here. Look at this wick. You know, you enter right here. This would be like aggressive entry, 6 pips stop loss. Amazing. You'd be there all day, but you get your 1 to 3 pretty quickly, right? And of course your target would be that missing price we were talking about. So those are double tops and double bottoms, and it's really just important to know that the wick can break out of the supply zone, but as long as it's confirmed by an engulfing back past the opposite side, like in your direction of your trade for reversal, then you're usually good to go. But yeah, that is, I mean, I hope this wasn't like super scatterbrain. Like, I don't plan these out, so I don't really know how they turn out until people tell me, like, oh, thanks, that was helpful and so on. Like, I'm hoping that this was good enough to kind of follow along with my back testing stuff, because yeah, I just wanted to make sure that kind of people can understand what I'm doing and make sure that it makes sense. So yeah, I mean, if there's anything else that anyone wants to know, like, let me know in the comments, and I'll make a video about it, and you'll see where we go. I'm actually working on the you know, my background video and stuff right now. It's gonna be pretty long, so hopefully I'll retain y'all for 3 minutes, and then y'all be like, all right, this guy's just talking now. But I'll try to put chapters on that one and like section it out so it's not crazy. Anyways, yeah, thank you for watching. Let me know if you have anything else you guys want to know about, or anything I forgot. I'll try to keep thinking of things for this, like how I trade stuff, and maybe I'll find something else that's good. Thanks for watching.